Alrighty, folks, it is official. Trump is in office. He's been in office for roughly 24 hours. He's been very busy putting pen to paper on executive orders. I just wanted to check in with Anna and see what she is thinking about the economy, what changes, if anything, now that Trump is in office and Biden is not. What do you think?
I think there's a lot of economic optimism with the new presidency, a lot of hope that he starts to turn the economy around, as obviously we've had a very, very painful economy, since COVID, blamed for better or worse on Biden, lots of, different things going on. But I think generally there's a lot more optimism that he can use DOGE, for example, to cut the deficit, potentially bringing U.S. Treasury rates down, slowing down inflation. And obviously, that's what a lot of real estate investors are hoping for, investors from everywhere. But there's also a lot of concern by many as well that some of the policies could potentially be more inflationary, that he's going to continue to spend, that DOGE may or may not be successful. There's questions about what the immigration policies that he started to sign those executive orders for might do to wage inflation, to jobs, et cetera. So I think there's a lot of optimism, but also a lot of concerns by people that really aren't understanding what is the so what and the trickle down of these policies, and then how quickly some of these things might actually materialize in the economy. So those are some of the things I'm kind of thinking about and the questions that I'm constantly hearing from my followers, on your show as well as we read the wonderful comments and the quotes.
Yeah, one of the things I want to do is I'll step back for a minute and just give Biden his flowers. I mean, at the end of his term, whether we like, whether you believe the numbers or not, the number is the unemployment rate was 4.1%, historically low. Stock market at or near, let's just say near all-time highs. GDP, I believe, is estimated to be 3%, his last calendar year. So, I mean, to say it was a horrible economy, probably not fair when you look at the collective economy. Where I think it kind of breaks down is where we look at kind of the stratas, right? The people that own assets, the top 20, maybe the top 30%, flat out better off, right? Just are. And then when you start going below that, it gets really, really scary. And that's frankly probably why he lost the election. One of the big reasons he lost is because inflation, for the bottom 50 for sure, probably the bottom 70 was in top of mind, right? Eggs are this, meat is that. It's just like it became too expensive to daily life just became too expensive. So I think I think we got to at least be somewhat fair, right? When you look at the masses, the numbers don't look that bad, but
sure.
Yeah, that's interesting.
I agree with you, to some extent. I mean, obviously, for all intents and purposes, people are saying, if you look at the financial markets, that we've basically achieved somewhat of a win against inflation, at least its current growth rate. Obviously, we're not going back and getting this 25% or so increase that we've had in many things like food over the last several years. We're not going back to those original prices. But in terms of the rate of inflation growth, to your point, it's really slowed. And historically, we have very, very low unemployment. So collectively at the aggregate, which is really important, for all intents and purposes, we have a strong economy. That's what the Fed keeps saying. That's what the president keeps saying. But I think, again, we have the same problem that a lot of countries do. You can blame the president, and I was not a huge fan of a lot of the policies of our last administration, but I also know, and you and I know and talk to a lot of financial experts that say our economic problems in the US started well before that, and really it's monetary policy from an independent agency that's been most effective, as well as some, fiscal policy as well from Congress in achieving what we have in terms of bringing inflation down fairly slowly. The issue is, as you said, though, 70% of the population living check to check, maxed out credit cards, small business bankruptcies, corporate bankruptcies. They are painful to the majority of Americans. And I think that's why many people also fairly say that the policies didn't achieve growth and a great economy for the majority of the people. The wealth
Totally
gap
agree.
continues to widen, but that has been a problem, to be fair, for decades across multiple administrations and in multiple countries. So it's not all Biden's fault that we have this bifurcated economy. It's definitely decades and decades and decades of fiscal policy, monetary mistakes. It's very, very complicated. So yeah, I think it's fair to be fair that the president doesn't impact the economy as much as what people think. There is definitely some impact as to fiscal policy, and going forward, fiscal policy might even have more of a role to play than monetary policy.
Yeah, I think where I'm going to go from here is I don't know if you've seen these couple of quotes from Stanley Druckenmiller, but I think he kind of put words to your feelings, and I think they're worth talking about. And so Stanley Druckenmiller, if you don't know who he is, he's been a stock investor, portfolio manager for 49 years. He has seen some stuff, and most people would put him on the Mount Rushmore of investors. He is that good. So if you don't know who he is, do yourself a favor and look him up. So he said two things. Number one, we are going from the most anti-business administration, Biden, to the complete opposite, Trump. Okay. Statement one. Statement two, probably even more interesting. Obviously, Stanley Druckenmiller, 49 years in the business, huge Rolodex of people he talks to. The CEOs that we talk to are somewhere between relieved and giddy that it is out with the old and in with the new. This is something I've been tracking since the election. We had started to see business sentiment surveys take, legendary rises. And I think we're going to start to see, the animal spirits of CEOs take off. I think Stanley Druckenmiller is right.
Yeah, I haven't read that. I will go back and read. I enjoy his thoughts and his commentary on a lot of different things economically. I agree with you to some extent, for sure, or agree with him to some extent in terms of when there is uncertainty and more regulation of companies and corporations and telling them what they have to spend money on. And again, I'm going to use a few things that are now they're backing away from, obviously, and regardless of where you are on the political spectrum, the reality is there was a lot of forced compliance to things like DEI regulations, basically what the far right would call woke policies, but essentially green, climate control, gender fluidity, people put into positions based on their race, based on their gender, based on their gender identity. Those things are very costly to a lot of corporations. I mean, a lot of corporations basically had to comply. And what some people might not even realize is even investment companies had to comply through changes mandated by the SEC and the IRS. And so, even to raise funds for funds of a certain size, they had to show that they had clean and DEI policies in their portfolio that they were going to push forward with those agendas. And so if you think about it just from a purely economic standpoint, regardless of where people are politically on the issue, when the government mandates that you spend a significant amount of your profits complying with things that don't generate revenue, it is going to make companies less profitable and creates all kind of internal warring and employees that sue and all kinds of headaches to administer those things. So I think by the executive orders that very quickly, I didn't go through all of them, but I did watch yesterday, pulling away from the Paris Climate Accords, changing some of those DEI policies. You already saw some companies start to reverse them once Trump won office because they realized these things are costly. So those are two real issues that regardless, I can't really say whether I know beyond that, whether it's true, whether Stanley Druckenmiller is right. I'm going to give him the benefit of the doubt, but that Biden was the least pro-business and Trump is the most pro-business. I don't know, economically how to put a number on that, but just those two things in and of itself are definitely positive things for corporations who want to profit. And if they can redirect that money into investment in people, quality people, and investment into the future, into technologies, into efficiencies, that is a positive for corporate profits. And therefore, it doesn't surprise me that at the corporate level, for the bigger companies in particular, that they're excited just for those two things alone.
Yeah, I think anytime you can remove a layer of an expense that, doesn't produce revenue, it's helpful, right? So at a minimum, it increases profit margin, but for most folks, it will be capital that they can reallocate somewhere else to a higher return.
Right.
And again, less regulation, less headache. CEOs are happy, right? Less stuff to worry about.
And the other thing, Michael, for their balance sheets, that just came to my head. Sorry for us to kind of overlap on our thinking there, but if they're saving money in those areas for those corporations that do still have balance sheet issues and they've got some debt that they've got to roll. I know that a lot of them are still worried about, if where inflation is, if government spending, starts to increase as it looks like it would through, Trump's financial plan, into continuing to spend for things like Build Back Better and reshoring, bringing, deglobalization. Those things can be inflationary, increase interest rates. But if they can offset some of those interest rates, take some of those profits and pay down their debt, even if it's at higher rates, they can start paying down some of that debt. And that can really help to shore up some of their balance sheets. So I think there's a real reason for some of that optimism when even if they think that the policies are going to be inflationary and cause interest rates to remain a little bit higher over time, if they can offset that with an increase in productivity and profits, it's positive, similar to the economy as a whole. You might have higher interest rates, you may or may not. We can kind of riff on the things that could cause that. But if you can get the productivity gains and you can get people spending money, as long as you can get GDP above the annual rise in inflation, you can continue a fairly stable economy and people can start making a little bit more to start paying down some of that debt.
Yeah, the last thing I'll say about CEOs and where I think they're thinking is mergers and acquisitions, right? The last SEC chair was frankly anti any of that. And I think the new administration is going to let companies merge and acquire. And I think there's a lot of companies out there that are thinking about it. In fact, Guarantee Bank Trust, I want to make sure I got this right. Yeah, just this morning, Guarantee Bank Trust, one of the comments they made is they're going to be looking for loan growth. Okay, they're a bank, makes sense. And M&A opportunities. Again, not to say that Guaranteed Bank and Trust couldn't have done an acquisition last year, but I just think it's that attitude. I think there's a lot more M&A coming. I think there's a lot of deals that would have been tried last year, but they just didn't think the administration would let them do it. And I think the handcuffs are off. So I suspect M&A will be a big part of 2025.
Yeah, I hadn't really thought too much through that, but yes, anytime you have deregulation, you don't have as many of these stopped mergers that we've seen between, airlines and all kinds of companies that basically the SEC has squashed and said, hey, we think it's kind of too monopolistic. And so, yeah, he's definitely a president that wants to deregulate and be pro-growth and pro-business. And his first executive orders are definitely showing that. So, the question will be, what I really haven't looked at closely enough to have an intelligent opinion about is, in terms of the corporations, when I look at growth and profitability, I do know that the vast majority of the S&P 500 companies are struggling. The Mag 5 or so right now, the Mag 7 has kind of decreased, really are floating. Most of the economy, I think I quoted last week, I believe it was Stephanie Pomboy that talked about how, consumer discretionary companies in the S&P 500, if you take out Amazon, have like a negative, I think 3% growth, although with Amazon it's 12%. So, are you going to have huge companies like the Mag 5, like an Amazon, buy up a bunch of, struggling kind of consumer discretionary? How quickly will the consumers come back to spend money when they're still living check to check, even though the corporations are real excited about it. So I tend to think most of the M&A will probably be around things like technology, infrastructure, energy, even potentially, some real estate types of things. I'm just not so sure we'll see it in some of those consumer discretionary. So it'll be something interesting to watch. It's definitely piqued my interest to say, if we're going to go in, and we're going to go in to invest in, companies that we think have some strong chances for more profitability under this administration than maybe before. What are those sectors that you really start to look at for potential really much more profitable companies than what we saw in the last couple of years?
Yeah. Well, let's just move to rates. Obviously, Trump is a real estate guy. I think it's fair to say that he wants rates lower than higher. I don't think that's crazy to say. I don't know that the Fed's going to play ball, right? The Federal Reserve is I think on hold for at least the next 6 months, in my opinion. I think if Trump had his way, they would still be cutting meaningfully. Frankly, Christopher Waller, Fed president, said that he's on board for maybe a March rate cut, which kind of surprised me.
Mm-hmm.
But what do you think? I think Trump wants lower rates. Not sure Powell's going to play ball, but curious what you think in there.
Yeah, the more that I study and try to figure out, okay, what is going to be the impact of immigration changes, of deporting immigrants who are here illegal? How many get deported? What jobs does that open? What financial expenditures does that reduce that we're currently funding to have them here? What does it do to wage inflation? All of those kind of things. It's very hard to get real data, Michael, on what those numbers are. And the experts who are looking at it have differences of opinion. But I would say this in general, that what the president wants has very little impact on what the Federal Reserve actually does. If you go look historically, they really are trying to balance, again, their mandates of inflation and unemployment, and also financial stability of the banking system, although they can't really say that that's a mandate. I mean, it's a huge mandate for them to have stability of the financial markets and the financial system. They don't want a massive stock market correction. They also don't want a massive bubble in real estate prices with affordability issues, but they have very little control over that aside from their tools of financial easing or tightening, which is really more about purchases of securities or sales of securities and interest rates. And quite frankly, with that said, that the president doesn't really have much control. I think the Fed has, as many central banks have, lost control of interest rates to some extent. They cannot lower interest rates in a highly inflationary environment and when fiscal policy is dominant. And we do have something now called fiscal dominance, where really it's the spending of the federal government that impacts Treasury rates more so than what the Fed does with short-term interest rates. And so, yes, Trump absolutely would like lower interest rates because it's pro-growth, it's pro-businesses borrowing at cheaper rates to invest in the kind of things that he wants to see go forward to, make America great again, to basically bring back manufacturing, which is in a deep slump and recession, to bring back some deglobalize certain things that are really products and services we use that are a matter of potentially national security, in that America First type of policy. So low interest rates tends to do that, because you end up having the corporations being able to borrow substantially large amounts of money, and the government borrows substantially great amounts of money to fund all of that. And of course, they want lower interest rates to do it. But with the period of fiscal dominance, especially when the Fed is really, they're not in control of those borrowing rates, not the longer term borrowing rates. They're kind of in control of these short term borrowing rates. When they have high inflation, they really can't cut rates significantly. And so I don't think that they can. And when they're looking at fiscal policy and the amount of money it looks like both parties are going to be willing to spend in order to fulfill some of these policies and have more long-term growth, they know that it is going to be inflationary. And the only way for them to pay for it, we've talked about it on this show in much more detail before, but is for them to allow more inflation. And that means that you are allowing interest rates to get a little bit higher, so that you have more inflation, it becomes cheaper to pay off this debt. And also for foreigners to continue to invest and buy treasuries if they believe we're spending a lot of money and we continue to have an increase in our fiscal cliff and our debt, then they will demand higher treasury rates. And so it's those higher rates that are going to really impact most of the corporate borrowing and real estate investors. So I think the fiscal policy is going to have a much bigger impact on where rates end up than, quite frankly, the Fed will. And I think Trump knows that. And so I think his pressure is going to have to be more on Congress to do the things he wants Congress to do, such as, putting back in the Trump tax cuts, increasing tariffs. Those are fiscal policy decisions, congressional policy decisions that are going to really end up pushing his financial plan forward, regardless of what the Fed can do with interest rates.
Yeah, I think one of the things that a lot of people miss, and you covered it well, but I want to hit it again, right? The Fed has already delivered 100 basis points in cuts, right? They control the overnight rate. So Powell can just raise his hands and go, dude, I gave you 100. The market, the long end is up 110 basis points, or let's call it 100 basis points. He's like, that's not my problem, buddy. Go to Congress, right? Stop spending like drunken sailors, right? So, I think a lot of people want Trump to just beat up Powell like he did in 2018, where he kind of beat Powell into submission and had him reverse course. But again, I don't think that's today. I think Powell can legitimately stand in front of Trump and say, I've given you 100 basis points. I've probably given you more than I should have. I don't control the long end. And Trump, I think, knows that. And that's why we have Doge. That's why we have the talk of tariffs, because you need to increase revenue or cut spending, because Powell doesn't control the 30-year mortgage, right? It's just, that's not where he is.
Yeah, and we've seen that. Look, he's given us 100 basis points cut in the short-term federal funds rate, and our mortgage rates have gone up 1%, the opposite direction. And again, it kind of comes back to the Treasury markets. When I say he's lost control, or Powell has lost control of interest rates, what I mean by that is that what happens with the federal funds rate, which was really the rate at which companies can borrow from the government or banks can borrow from the government, and then they, have this spread above that. Just to make it kind of simplistic, overly simplified, but the Treasury markets are really what is the rate that the private sector is demanding in order to invest in the U.S. government and its policies, essentially, because treasuries are issued by the government in order to fund, all the government's expenditures and its future, promises of a rate of return. And so because the Treasury markets, which is made up of big funds, it's made up of money, our Fed Reserve and Treasury actually buy some of their own treasuries, right? Issue and sell and buy back or whatnot. But you have a lot of foreign investors in foreign countries who are also buying treasuries. And so they're basically not looking at what is short-term U.S. inflation. They don't care. They're looking at what is the return I demand for the risk that the U.S. government can actually pay me back in the future in this next 10 years, if it's a 10-year treasury, for example. And if they believe that we're going to spend like drunken sailors and aren't going to be able to reverse, course, they are going to continue to demand those higher rates. And so, Powell understands that. Obviously Scott Bessent, our new incoming Treasury director, if he's confirmed, I don't think he's been confirmed yet, but it looks like he will be, understands this as well. But I think that, we have to be realistic with the fact that Powell is not the guy to beat up, whether you like his policies or not. It's far beyond their ability to control. I think the other thing, and I haven't really heard Trump personally talk about this, so all I can, say is what I've read about their policies. But the reality, the risk of lowering interest rates back significantly, which is obviously what real estate investors want, and others as well, is that there is still a lot of liquidity on the sidelines. There's still a lot of bank reserves. And so your smaller regional banks, there's a lot of risk again in the banking system. And there's a lot of smaller regional banks that have a lot of risk because of both bonds and commercial real estate on their books that they might have to write off, which could give them some insolvency risk over time if rates stay higher. But aside from those regional banks, a lot of the very large banks, Michael, they're actually very, very liquid. They've got a lot of reserves and they're still willing to lend. And there's a lot of people on the sidelines that want to borrow. And if you cut rates too low, you end up with significant borrowing, significant spending that into the economy, and you end up re-sparking inflation because there's so much of this animal spirits you open the show with in the corporate sector, then, the money in the stock market and people that now can borrow again at 2 or 3% interest rate. They're going to borrow it and then they're going to go spend it like drunken sailors. And you're going to end up with more inflation from both a monetary policy driven inflation and a fiscal policy driven inflation from the spending. And I think that that's a really bad combination. Even though I'd love to see interest rates again, I think the Fed has been able to achieve, for better or worse, at least at this point, somewhat stable interest rates on the short term that are getting more equilibrium to where inflation is kind of coming down. Balance sheets are being shored up. You've got some commercial real estate and other companies that are going bankrupt, but unemployment hasn't gone up significantly. So I think that they're going to stay really slow and steady. I still think that they should cut a little. I wish I could say they should cut more and get my interest rates really low, but barring a recession or financial crisis, which is not off the table, but barring that happening, I think that they're going to continue this approach of saying, hey, there's a lot of things we can't control. There's a lot of things that could come out depending on what Congress votes on in Trump's agenda that could have consequences, good or bad, in terms of inflation and employment. And I think that they're going to take this watch and see how far above neutral are we really. And if we start to see a real uptick in inflation, then I think they hopefully just pause rates and don't raise them. But I think if we start to see a real uptick in unemployment, that they may continue to cut. But I think it's going to be very slow, very methodical. And I don't think we're probably going to cut more than 0.75% to another % this year and then maybe stay there. That would be kind of my best case scenario for rates coming down. Again, what does that do to the Treasury markets? I don't think it does much. I think Treasuries could continue to go up.
Yeah, it's you and Joseph Wang, the Fed guy 12 on Twitter. He's also, I believe, calling for 3 or 4 rate cuts this year. So you two are absolutely in the same camp. I'm on the 0 or 1 camp, preferably 0. But
and listen, I'm not saying that is my prediction. It's just I think it's a possibility. Sure. I think it could be none. And a lot of it depends on, honestly, Michael, how much the new policies impact sentiment and how many companies start to really lay off this year. So, that's the big question, is where does unemployment go? If unemployment starts to tick up, and there's still a lot of risks that can happen, especially in the small to medium-sized businesses that don't have quite strong balance sheets to survive these rates another year or so. If that happens, they will have to continue to cut, maybe down to 1%. But if we don't see the big layoffs and we see companies so excited that they just hold steady and unemployment stays relatively low, then I would be more joining you on your camp that we may not get much more than 0.25%. And if inflation starts to go up again, we could even have the dreaded rate increase. Yeah. So I just think, what I know is that all these predictions are never right because it's complicated, way more complicated than what we even know and what the experts know, and too many unknowns. And the other thing, Michael, that makes me, for lack of a better word, not to really want to throw out a prediction there, is that I don't remember where I heard this, but it was a really good point that many countries are having a complete change of guard right now. And many countries are going back to very much their country first type of policies. The globalist cooperation's kind of dead unless they're a country that really relies on us for exports. Everybody wants to say, hey, we're tired of all the policies that are like, give our money to other people, for lack of a better word, global socialism. And they're back to me first, my country first policies. And that can have a huge impact on currencies, which not very many people are talking about, on trade deficits and trade balances. And in the past, it's resulted in trade wars, currency wars, and those things can have a huge impact on the value of your currency, on your treasury rates, on foreign and local investment. So there's just a lot of things that I think we truly are in a new era. And while we like to say it's not different this time, to some extent, like what are the policies tools of the Fed, and what does the government do when they need to get us out of debt or whatnot, the conditions globally are significantly different today than they were in any of these past periods we like to look back at, like the 20s and the 70s and the 50s and the 2008s, to say where are things going. The reality is it's much more complicated and getting more complicated to figure that out. And when you have the central banker of the United States saying, we don't know if our predictions are right, we don't know where things are going, they're telling you the truth. They don't know. Their models are no longer working. And it's why it's been very difficult for people like us, even though we're students of the economy, to really predict with any real accuracy. But with all that said, I think the next decade is going to be more inflationary than people like and hope. And that generally requires and fuels government spending and higher interest rates. And so I still come back to my, the next decade or so is going to be volatile. It's going to be bumpy. We need to expect the unexpected and, do good deals for where your rates are at any given time. Lock in those rates because nobody really has any idea exactly where things are going. And that's the reality.
Yeah. We're going to take a right turn that I didn't know I was going to do. We're going to do it anyway. It sounds like you watched the ceremony yesterday, the inauguration. Curious if there was one or two moments that stuck out to you. I have a couple of moments that stuck out to me, which I'll get into. But anything stand out to you yesterday?
I'm afraid to say what I really think.
Well, I'll give you some time to think about it.
No,
I thought,
yeah, you go first. But yes, I mean, there's lots of moments that we can say without sounding super political. But you go first.
So the first one for me was Carrie Underwood. Carrie Underwood singing. I think it was "God Bless America." I think it was.
Yes.
Whatever it was.
Yes.
Watching her wait patiently for the music to start, it not to start, and then her to mouth the words, "I'll just sing it," go a cappella, and ask the crowd to, if you know the words, sing. I thought was just a beautiful moment. I
loved it.
Yeah, kind of a really good spirit. I actually went and saw a Carrie Underwood concert a couple of years ago. I think in San Francisco. I don't remember. Maybe Vegas. She's a wonderful singer and performer. So if you ever get the chance to see her, do it.
Oh, yes. I went to see her in Nashville. I took my kids to see her in Nashville at the Grand Ole Opry last year or the year before. And she was incredible. And just I loved it. And I thought, you know what? It also embodied the spirit of America. The song America the Beautiful, like we wing it, like things go wrong. You don't know what's going to happen and you just got to keep moving. Right. And so I loved that, and just kind of the symbolism of, things don't always go the way that we plan, no matter how well we plan. Are you just going to stop and let the moment go by? Or are you going to take advantage of it and say, hey, we have hope, we have resilience, and we're going to go for it. We're going to do our best under the circumstances. So I loved that. As a singer, I thought, of that, but I think as a big picture was just a beautiful symbol of the spirit of America.
Yeah, that was one for me. My hype song when I want to go work out is actually a duo between Carrie Underwood and Ludacris. I believe this song is called "Champion," If you haven't seen
Oh
that,
yeah.
it's a really cool collab between those two. And then the
Yeah.
other really special moment I thought, again, as a parent, was when President Trump singled out his son Barron and asked him to stand. First off,
Yeah.
boy, that guy is tall. He's
He
like
is.
6'9", 18, 6'9". And then to watch him get his flowers and be very, very measured. Right? I couldn't imagine being an 18-year-old having all these eyes and applause, and he was so measured, soaking it in.
Yes.
Pretty impressive. I don't know many 18-year-olds that could have handled it that way. So those are two things that stood out, very non-political, but
Yeah.
I thought they were pretty special moments.
Yeah, I did too. And I also really appreciated, and I don't know that we couldn't really see it, but I thought two other stories that are just kind of really feel good to me. One was seeing JD Vance and his mom there, watching him become, the first Marine, 40 years old, becoming vice president of the United States. I've read his story. I haven't seen the movie. I think it's called Hillbilly Elegy, but it's on my, bucket list to watch. But, a single mom addicted to drugs, father left, and just to see like her standing there and seeing her son, elected vice president. My grandfather was an Iwo Jima Marine, and I think he's the first Marine that's actually vice president of the United States. So, just enjoyed seeing that story. It gives me hope for our military, which quite frankly had gone, I will say this politically, in my opinion, too woke, rather than focusing on, and President Trump said this in his inauguration address, protecting and defending America against our enemies, foreign and domestic. And so, I'm paraphrasing, but, it gave me hope that we will get back to what our U.S. military is supposed to be. And then the other thing was seeing, and I apologize, I don't know her last name, but one of the victims of the October 7th attacks in Israel, her name was Noah. She was one of the early hostages released. She was there right behind President Trump with the families of those hostages that are still not released. And so for him to bring them, both American and Israeli, to the inauguration and commit to them that he will do everything he can to help bring those hostages home was a very touching moment for me. And I have hope and optimism, and I think a lot of people do as well, that we start ending some of the conflicts, or at least Trump putting a lot more pressure on these conflicts, radical Islamic groups against Israel, Putin and Ukraine, all of these escalating conflicts, that he's able to somehow put enough pressure and say, we're serious that these things need to stop. So I think a lot of people were very hopeful by that yesterday.
Well, let's talk about the Ukraine war. One of the things that I put out there that I'm very hopeful for is there's a ceasefire in the next 90 days. It would be nice to, be in a world where the Hamas Israel thing is behind us, where the Ukraine Russia thing is behind us, and we just settle into a more peaceful world.
Yes. Yes.
I can't see why that would not be just a wonderful thing to hope for. So I hear that Putin's willing to negotiate. Yeah, I would hope so.
Yeah, we should all want that.
Yeah, so that's something I'm very hopeful for. Let's move to tariffs. Again, I think tariffs are it's not a four-letter word. It is certainly a word that Trump loves to use, loves to threaten, loves to swing the big stick. I think it's just all classic New York negotiation. But we'll see, I guess. How do you see tariffs being used, threatened to use? Where do tariffs go? Because if they're done poorly, it will be inflationary.
Absolutely. Absolutely. I've heard different statistics on what is the reality of the tariffs. One thing is it could cost the American consumer significantly more and restoke, inflation for a lot of our goods here. I've also heard that really the tariffs are very much focused on products that, generally speaking, have significant profits for the foreign companies who are exporting them to us. And therefore, they typically do absorb the cost. and that very little of it's actually passed through in the prices of those goods in America, and that net, there's not a significant increase, because it's not like the media that are the ones that are like, this is the worst thing we could possibly do, it's going to stoke mass inflation. The reality is the tariffs are on a very selected number of goods and services, things that generally we want to bring back manufacturing of. So I'll just talk about the auto industry, for example, right? Auto manufacturing in the United States has gone down. Manufacturing's in a recession. If we were to put tariffs on, vehicles that are foreign made, and we start to produce vehicles here less expensively, then net, it could have very little impact on what Americans pay for for vehicles. I don't know enough about the details, but those that I've heard that have been economists that have worked with tariffs say it does boost the income of the United States to help offset like tax cuts for individuals, for example, and it has very little inflationary impact. The question is going to be, Michael, because we are in a different world than we were, when Trump was in office before, we just are, and even further back when tariffs have worked very, very well. A lot of the countries that rely on exports to us are in a very precarious financial situation themselves. They do not have strong economies, and they really can't afford to lose the exports or to pay significant tariffs. And so that could create issues with the dollar valuation compared to the currencies of other countries, getting back to kind of creating currency wars and trade wars. If it creates significant imbalances and the countries are not able to meet their own country's fiscal agenda for growth without exports that don't have 20, 30, 40% tariffs. So it could create more volatility, more anger, more hostility that could stoke things. I'm going to pick on China, right? We've recognized like China is our biggest competitor as a nation. They also are basically proxy funding some of the Russia-Ukraine war stuff. They're allied with, Russia, North Korea, what we would say are not our allies, whether you want to call them enemies or not. It could stoke more anger, and that could stoke more potential wars, whether it may not be a hot war, a military war, but we already have them surveying our company. We already have them going after our grids and internet systems that control airlines and financial systems. So it's like, that's where the real questions are, is does it create more hostility, and is it worth it? And will they work? So that's one of those things that could go terribly wrong. The other thing is, depending on what it does to our currency valuation, it could make producing those things in the US more or less profitable and more or less expensive. And if you have a lot of foreign suppliers sending stuff that no longer can, you end up with the potential that American corporations start really jacking up the prices and causing inflation for those same goods that you wouldn't have if you were getting them more cheaply from other countries. So I don't know enough to say what is going to happen, but I know enough to say those are kind of the risks that I think we need to look out for.
Yeah, the last thing I kind of want to riff on, and I highlighted for my audience, there's two things that I'm watching for kind of over the next 90 days. One is interest rates. We've already hit on, right? Are we gonna suddenly approach 4%, or are we gonna be stuck at 5%? Right? That's kind of, where we're gonna be in a tug of war with the 10-year. The other one though is oil. I think oil could be a sneaky, pleasant surprise.
Yes.
Because as you know, oil is in everything.
Yes.
And if we take on the drill baby drill, we turn on the spigot, we could see oil go to $60, and that's a 25% drop. Fund Strat's talking about $40 oil. I think you get too much of Saudi Arabia and others just turning off the spigot to make that reasonable. But at $60, that impacts the middle class. That impacts the lower class. Gas goes down, 20%.
Yeah.
Shipping stuff goes down. So I think oil is the sneaky commodity to watch in the next 90 days. What do you think?
Yeah, that was another big moment. I heard him. I don't remember if it was during the actual speech or it was one of his, off the cuff speeches after the actual speech. But he was very clear: drill, baby, drill. We are all of these policies that basically shut down, oil and gas production, like we're turning back on the spigots. And it does generally take some time. Again, I'm not an oil expert, but I've listened to a bunch of them. It takes some time for these things to come through, but definitely the all of those things are part of inflation. And so when you have energy that's cheap and less, it does make the cost of goods come down, and to some extent your services, because if you have cheaper energy and cheaper electricity, for example, cheaper heating oil, in the north, you can provide services less expensive as well as your expenses come down. So, the interesting thing to me about how it impacts rates is that goods inflation is already coming down pretty strongly. We're already on a fairly deflationary path, or at least a disinflationary path, on goods within our CPI. So most of our increased costs right now are really related to insurance, healthcare, real estate, for example. And those things can't really come down without either interest rates coming down or all of the costs of providing those services coming down. So things like cheaper energy can, alleviate some of that. And then maybe we start to see some of that services inflation start to come down, where we get closer to that 2% inflation target, increase than what we are today. And that could also allow the Treasury or the Federal Reserve to start thinking about bringing interest rates down a little bit. So yeah, oil will have a huge impact.
I think oil is the sneaky
untalked
thing, because it could lead to a lot of positive things. It frankly, $60 oil, I'll say it right now, I haven't said this before. If we have $60 oil, the Fed will cut rates. And as people know, that's not my call. So, but again, what $60 oil is it's not only deflationary or disinflation, it could lead to true deflation.
Right.
So it is something to think about. Anna, this is a fun conversation. It is always exciting in the U.S. economy. Where can people follow you and see what you're doing?
Great. You can find me here every week on your show. You can find me for real estate and wealth coaching and consulting at AnnaKellyInvesting.com and at social media at Anna Kelly, REI Mom.
Thank you so much. Have a great week.
You too.